Welcome to Junior Mining Gold, the podcast where we dig deep, pun absolutely intended, into the raw, unfiltered world of building fortunes from the ground up. I'm your host, Dusty Nugget, the guy who's seen more boom and bust cycles than a Wall Street trader on a bad acid trip. If you're new here, we don't sugarcoat the grind. We expose the guts of business, from solo hustles to empire-building shares. Before we dig into the dirt, this episode is brought to you by JuniorMining.Gold. Are you tired of missing the boat on the next big discovery? JuniorMining.Gold is your ultimate radar for the high-stakes world of small-cap mining. We track the drills, the assays, and the movers so you don't have to. If you want the edge in the Outback, head over to JuniorMining.Gold. Now, let's get to the gold. Today's episode is episode 1, and we're calling it Marmota's Gold Rush Gambit, Digging for Glory in the Aussie Outback. And I want you to settle in, because this isn't a hype piece. This is a long walk through how a real junior miner is trying to turn dirt, chemistry, geometry, and patience into cash flow, and where the real risks and rewards live. Let me hand you a mental model right up front, because this is where most investors get hypnotized by shiny numbers, and then wake up later holding a bag of regret. A gold mine lives or dies on 4 levers: depth, hardness, recovery, and scale. Depth is how much dead dirt you have to move before you touch meaningful gold. Hardness is how much energy you have to burn to break the rock. Recovery is how much gold you actually get out once you've found it, and scale is whether the project runs long enough and big enough to matter. If you remember nothing else from this episode, remember this: mines don't fail because gold disappears. They fail because costs sneak up faster than ounces. Now let's clear away the biggest myth in mining. Most people think mining is about finding gold. It's not. Gold is easy to find. Humans have been finding it for thousands of years with pans, sticks, and desperation. Mining is about finding gold that you can extract cheaply, consistently, and at scale. Everything else is just glitter. Marmota's story matters because they're not chasing some deep, exotic, science fair project deposit that needs a wizard, a miracle, and $1 billion processing plant to work. They've been consolidating ground in South Australia's Gawler Craton, country validated by the Challenger gold mine, which produced more than 1 million ounces and proved the region can host real, grown-up deposits. Marmota's Arc of Gold thesis is basically this: there's a big regional gravity feature. Think of it like a hidden highway in the crust, and the flanks of that structure are where mineralizing fluids moved and dropped gold. Marmota has stitched together a large land position along that trend, trying to own the chessboard, not just one square. Here's the pub version of their bet. If the gold is close to surface, if the rock is soft, and if you don't need a giant mill that eats electricity like a hungry god, you've already stacked the deck in your favor. Marmota is betting that boring geology, combined with smart metallurgy, can outperform flashy discoveries that cost a fortune to build and a decade to permit. There's a quick detour we need to take here, because this is the part where a lot of junior mining stories quietly fall apart. Maps look great, drill holes look great, PowerPoint decks look amazing, but none of that tells you whether you're listening to a real mining story or a very expensive bedtime story. So here's the adult question I always ask, and you should too. Who's actually driving the geology, and why should I trust them more than the other 50 companies waving the same buzzwords and the same stock photos of a drill rig at sunset? Marmota's story has a credibility tell that most juniors don't. Their technical leadership includes Dr. Kevin Wills, the same guy Marmota has publicly credited with designing the calcrete sampling program that helped lead to the discovery of the Challenger gold mine. Not advised on, not inspired by, actually designed the program. Same state, same broad geological neighborhood, real mine, real ounces. Now, let me be crystal clear before anyone gets weird about this. This is not hero worship. Nobody gets a Lifetime Achievement Award in mining. The ground doesn't care who you are. But track record matters, because geology is pattern recognition under uncertainty. If someone's already found a needle in this haystack, I pay attention when they say, hey, needles in this region tend to show up over here. That doesn't mean they're right. It means they're less likely to be guessing. And this is where I start filtering hard. Junior mining is absolutely full of promotional noise, companies that can raise money on vibes, publish glossy decks, and somehow never build anything except a bigger share count. A real technical track record doesn't guarantee success, but it dramatically reduces the odds that you're funding a fantasy novel where the final chapter is always more drilling required. Here's another tell I look for when a project might actually be graduating from science experiment to business. The team starts hiring people who know how to break things, not just find them. Marmota brought in Paul Richardson as JuniorMining.Gold project manager, mineral processing background, decades in operations. That's not a drill cheerleader. That's a how do we actually turn rock into money without lighting cash on fire hire. Because drilling holes and running a mine are two completely different sports. One is exploration, the other is execution. Most juniors never make the switch. They just keep drilling until the market gets bored and wanders off. So when you hear Marmota talk about the Gawler Craton and the Challenger legacy, don't hear it as marketing fluff. Hear it as a diagnostic question. Is this team applying a proven regional model with people who've actually pulled it off before? And are they building the bench strength to survive the boring, dangerous middle of the story where engineers replace geologists and spreadsheets replace hype? If the answer is yes, you lean in. If the answer is no, you treat it like what it is, an expensive field trip with shareholders paying for the bus. And that's the difference between a junior miner that might grow up and one that just keeps issuing press releases until the coffee gets cold. That brings us to Aurora Tank, because this project is the backbone of the whole strategy, and it's where Marmota starts to shift from interesting explorer to serious operator. Aurora Tank sits in the Gawler region, not far from that Challenger neighborhood, and it became a bigger deal when Marmota consolidated full control after earlier work by another explorer had already shown gold near surface. Early holes included intervals like 4 meters at 5 grams of gold per ton from 16 meters depth, the kind of result that makes people stop scrolling and start reading. Over time, drilling kept upgrading the story, including some ridiculous 1-meter hits with triple-digit grams per ton, like 1 meter at 165 grams per ton, around 57 meters downhole. High-grade sprinkles that can supercharge early cash flow if they're real and repeatable. Now, I'm going to say something that sounds obvious, but it's the difference between a mine and a meme. It's not enough to have gold. You need gold that comes out of the rock without a fight. This is where heap leaching enters the chat. Heap leaching is one of those unglamorous techniques that quietly makes a lot of money when it's matched with the right material. You mine the rock, crush it into manageable chunks, stack it into a lined pile, and irrigate it with a solution that dissolves gold. The gold-bearing liquid drains out the bottom, gets processed, and the money shows up, slowly, steadily, and with a lot less machinery than a traditional milling operation. The trade-off is usually lower recovery. Many heap leach mines are thrilled with something like 70% gold recovery, meaning 30% of the gold stays trapped in the rock forever. That's just business. But Aurora Tank's metallurgical testing is pointing to something much more interesting. Exceptional recovery and fast recovery in material that's been naturally weathered into softer, more friable rock. In one key composite, column leach testing achieved about 93% gold extraction at a crush size of 8 millimeters over 59 days, and even with a coarser crush size, 12.5 millimeters, it still hit about 89%. Across the composite mix, the weighted average recovery was around 86%. That's not good for heap leach. That's, you might actually have a real low-cost pathway here. And the kinetics matter as much as the headline recovery. The testing showed that more than 55% of the gold was extracted within the first 10 days of leaching. Translation: money comes out early, not just eventually. Fast leaching reduces the amount of gold tied up sitting on the pad as gold in process, which improves project economics because earlier cash flow is worth more than later cash flow. Now this ore has personality. It's slightly acidic in its natural state, with pH readings around 5 point something, so they used cement in agglomeration, basically binding fines into little pellets, so the heap stays permeable and doesn't turn into a clogged mud cake. Cement dosages in testing were on the order of 20 to 25 kilograms per ton, which is meaningful but not crazy if it's the price of getting high recovery. Cyanide consumption was described as moderate, with an expectation that field consumption could land around 0.4 to 0.6 of a kilogram per ton for a shorter leach cycle. Also helpful, low silver, low sulfur, and generally low nuisance elements that can chew up reagents or create environmental headaches. Now let's translate this into money, because mining is a business, not a geology scrapbook. There's a brutal concept called the cutoff grade, the minimum gold content that pays for mining, processing, and overhead. Below it, the rock is waste. Above it, it's ore. High costs force high cutoff grades. Low costs let you mine lower grade material and still make money. Because Aurora tank looks like it can be mined near surface, processed via heap leach, and recovered at unusually high rates, the economic cutoff grade can be very low. In the analysis, when you plug in high recoveries and a strong Australian dollar gold price environment, the break-even math can get shockingly low in theory, on the order of 1/10 of a gram per ton under optimistic assumptions. But in practice, projects often apply more conservative reporting cutoffs, and the discussion lands in a very low cutoff regime, roughly 1/4 to 1/3 of a gram per ton, as a realistic kind of threshold for modeling and reporting. Translation: rock that many projects would throw away can become part of the mineable envelope here. There's also a dirty little detail that can matter: how you measure the gold. In some high-grade systems, traditional fire assay sampling can underreport grade when coarse gold is present, what miners call the nugget effect. Marmota's work highlighted that when they used a bulk leach extractable gold method on a high-grade interval that had been reported at 50 grams per ton by fire assay, the larger sample leach method averaged about 87 grams per ton, about a 73% uplift. That doesn't mean everything is 73% better. It means grade reporting can be tricky, and the true recoverable gold may be higher than a simple assay headline suggests. Now, I want to plug this into the life cycle framework mining investors whisper about, like it's a secret handshake. There's a point in every mining story where the applause dies down, drill results stop shocking people, the stock stops moving, and suddenly nobody's excited anymore because the work gets boring. That's the valley in the mining life cycle, where engineers replace geologists, spreadsheets replace hype, and value gets built quietly. Most retail investors hate that phase. That's exactly where money is made. Aurora tank is leaning into that boring phase: metallurgy, cutoff grades, mine planning, and a potential heap leach development concept. Meanwhile, Greenwood and Campfire Bore are still throwing sparks on the discovery side: drilling, extensions, and the kind of results that create excitement and re-rating. Marmota is straddling both worlds, and that dual positioning can be a feature, not a bug, if management doesn't screw up the transition. Let's talk Greenwood, because this is where investors start talking sloppy. Greenwood is part of the same broader Gawler Gold story, and recent drilling defined a high-grade corridor close to 900 meters long. In a major stage of reverse circulation drilling, they ran roughly 146 holes for over 15,000 meters, and the highlights included thick zones like 33 meters at 10 grams per ton, starting from about 22 meters depth, plus very high 1 meter hits in the bonanza category. Things like 1 meter at over 100 grams per ton at shallow depth. Then a second stage expanded drilling further, pushing infill and extension work to firm up a resource-style understanding. The key point is not any single hole, it's the emerging continuity across meaningful strike length at shallow depths. Campfire Bore is the quieter sibling that still matters. It's another near-surface gold system in the same arc, and the strategy isn't necessarily to build a separate standalone operation. It's to feed a central processing concept. Think hub and spokes. You build the heap leach pad and recovery plant once, then truck or feed material from satellite deposits into the same system. Marmota has openly framed a scoping study concept around a centralized heap leach facility on the order of 1 million tons per year. Scale lowers unit costs, and satellites can sweeten grades. This is where most people miss the real plot: volume. Grade gets headlines, but volume determines whether the business lasts 5 years or 20. A volume and gold content analysis approach using deposit footprints, thickness assumptions, density, and grade distributions shows why a system matters. Greenwood has been modeled with a footprint on the order of 900 meters by 100 meters, and mineralization from roughly a couple dozen meters to several dozen meters below surface in places. Campfire bore roughly 800 meters by 100 meters in the conceptual footprint. Aurora tank with a larger footprint on the order of hundreds of meters by hundreds of meters with mineralization thickness assumptions extending down toward 100 meters in the conceptual model. The numbers in that analysis are explicitly framed as conceptual and calibration based, but the takeaway is clear. Even modest grades become meaningful ounces when you have scale, and scale becomes economically viable when your cutoff grade is low and recovery is high. Now let's do the calm, professional, almost bored reality check. What could kill this project? Heap leach performance in the field can disappoint compared to lab columns. Real heaps have channeling, weather, operating mistakes, and variability. Nature is always more creative than your test work. Water access and permitting can delay timelines, especially in arid regions where every drop becomes political. Capital markets can freeze at the worst time, and juniors are allergic to tight money. Gold prices can dip and compress margins, especially if your cost assumptions were optimistic with vibes. And the big one, execution risk. It's one thing to drill holes and publish exciting results. It's another thing to build and operate a mining system without stepping on rakes. But notice what's missing. There's no unproven chemistry, no unstable jurisdiction, no billion-dollar plant that must work perfectly on day one. These are normal risks. Boring risks, not existential science project risks. Now I'm going to rant for 60 seconds because it will save some listeners actual money. Most investors misprice junior miners because they overweight drill grades and underweight metallurgy, operating costs, jurisdiction, and simplicity. Big grade numbers trigger dopamine. Metallurgy triggers yawns. And yet metallurgy is where projects either become mines or become PDF collectors. Retail investors love lottery tickets. Miners that survive are more like vending machines, boring, reliable, and always working when you shake them. Let's bridge geology into markets with a quick capital structure check, because this is where great projects get ruined by math. Marmota's share count is large. Over 1 billion shares on issue is not small, and that means dilution discipline matters. The company raised money in early 2025, about 5 million Australian dollars at roughly 5.5 cents per share, then reported a cash balance of about 3.7 million Australian dollars later in 2025. Insiders own a meaningful chunk, roughly 1/5 of the company by one snapshot, while the executive chair is a notable holder himself. That alignment can be a good sign. It doesn't guarantee anything, but it means dilution hurts the people at the table too, not just the listeners. Now zoom out and run a gold price scenario thought experiment with me, because the best projects are the ones that don't need perfect conditions. If gold stays flat, low-cost, high-recovery heap leach concepts can still work, because your cutoff grade is low and your operating model is simple. If gold spikes, the whole ore envelope expands. More material becomes economic, mine life extends, and satellites that looked marginal suddenly look like accelerants. If gold dips temporarily, high-cost projects suffocate first because their cutoff grade jumps and their margins evaporate. Low-cost projects wait it out. That's the difference. Low-cost projects don't need perfect markets. They need time. Let me translate 3 mining phrases one more time, because if we're building an audience, we're building educated sharks, not confused minnows. When geologists say near surface, they don't mean easy money. They mean cheaper access and less waste movement. When someone says 90% recovery, they mean the gold turns into revenue instead of staying trapped as fantasy metal. And when engineers talk about cutoff grade, they're talking about dollars, about whether each ton of rock is a profit center or a liability. So here's your closing investor checklist, the one you should tape to your forehead before you buy any junior miner, because a stranger on the internet posted a screenshot of a drill hole. How deep is the gold, really? And how much waste must be moved to get it? How hard is the rock, and how much energy will it take to break it? How much of the gold actually comes out in a realistic process, not just in a glossy presentation? Can this thing scale? Do you have a system, or do you have a single lucky hit? What's the capital structure? Will your ownership survive the journey, or get watered down to homeopathy? And what happens if nothing exciting happens for 2 years? Because in mining, that's not a crisis, that's a Tuesday. If you can answer those questions calmly, you're not gambling, you're investing. Before we wrap this up, there's one more layer to Marmota's story that most people completely miss. Mostly because it doesn't fit neatly into a gold-only narrative, and Wall Street hates anything that requires holding two thoughts at once. While everyone's been staring at drill holes and leach columns, Marmota went and stumbled into something else entirely at a place called Muckaninny. And I say stumbled loosely because this wasn't luck, it was pattern recognition. A geological review identified a massive ancient river system, what geologists call a paleochannel, running straight through Marmota's ground. This thing is big, tens of kilometers long, kilometers wide, and it turns out it's packed with titanium-rich mineral sands sitting right at surface, not buried, not exotic, just sitting there, waiting for someone to notice. Here's the part that should make you blink. Typical mineral sands operations in Australia are happy processing ore with 1 to 6% heavy minerals. At Muckaninny, Marmota is reporting heavy mineral concentrations north of 20%, with some zones pushing past 50%. That's not incremental. That's not nice upside. That's, are you sure this isn't a lab error territory? And when they cracked it open properly with X-ray analysis, the mineral mix wasn't junk. It's dominated by high-value titanium minerals, rutile, pseudorutile, and leucoxene. Leucoxene in particular is the good stuff, high titanium content, industrial demand, pigments, welding rods, the unsexy things the modern world actually runs on. The best part? This wasn't discovered because someone drilled blindly. It was found because someone connected old data, modern geological thinking, and public survey work that was literally published months earlier. That tells you something about how this team operates. Now, is Marmota a titanium company? No, not today. But this is the kind of optionality the market is terrible at pricing until it suddenly can't ignore it anymore. And then there's uranium. Junction Dam has been sitting there quietly for years, right next door to Boss Energy's Honeymoon mine, one of only a handful of permitted uranium operations in the entire country. Same ancient river system, same geological plumbing. Marmota's ground actually bookends the paleochannel on both sides as it runs through the Honeymoon lease. They already have a defined uranium resource there. Exploration didn't stop because the geology failed. It stopped because Fukushima happened and the uranium market collapsed. That's cycle memory, not project failure. Now nuclear is back in the conversation. The permits are already real next door, and Marmota has re-engaged experts to revisit and expand the resource. Again, not hype, just optionality that wakes up when the cycle turns. This is why I don't think of Marmota as just a gold junior. It's a company built around shallow systems, simple extraction, and geological ideas that scale across commodities. Gold is the lead act. Titanium and uranium are the encore options the market hasn't priced yet. You don't buy that for today, you notice it, so you're not surprised later. That's it for this week's dig. If you want more deep dives into the miners making moves, don't wait for the next episode. Get the data yourself at JuniorMining.Gold. They are the leading edge for junior resource investors who want the truth without the fluff. I'm Dusty Nugget. Stay bold, stay scrappy, and I'll see you at the next drill site.